The 2023 bull run is being propped up by tech. The S&P 500 is up about 18% to date, while the technology sector is up almost 42% over the same time frame. This discrepancy is ridiculous and will likely continue as these companies enter more facets of our everyday lives. In this video, we're taking a look at the best overlooked tech stocks on the market that also pay healthy dividends. Let's get started with Broadcom Incorporated. Broadcom Incorporated is a global technology company that designs and manufactures a wide range of semiconductor and infrastructure software solutions. With its diverse product portfolio, Broadcom generates significant revenue through its various business segments. One of the primary sources of income for Broadcom is the sale of semiconductor products. They produce a broad array of chips, including wireless communication chips, networking chips, data center chips, and storage chips. These chips are used in smartphones, routers, switches, servers, and various other electronic devices, making Broadcom a key supplier to many tech giants worldwide. In addition to semiconductor sales, Broadcom also earns substantial revenue from licensing its intellectual property. The company owns an extensive portfolio of patents related to wireless communication technologies, which are essential for modern smartphones and other wireless devices. Through licensing agreements, other companies pay royalties to Broadcom for using their patented technologies, adding another stream of income. Furthermore, Broadcom provides enterprise software solutions for managing network infrastructure and data centers. Their infrastructure software products cater to the needs of data centers, ensuring efficient data management, security, and connectivity. These software offerings generate revenue through licensing and maintenance services. Overall, Broadcom's diverse revenue streams from semiconductor sales, IP licensing, and infrastructure software sales have enabled it to become a major player in the technology sector and a financially successful company. AVGO's current dividend yield is 2%, which is lower than their 5-year average yield of 3.12%. Broadcom's 10-year dividend growth rate is 27.4%, and their 3-year dividend growth rate is 14.6%, indicating they're decreasing their dividend growth. AVGO has raised their dividend every year for the past 14 years, making them a dividend contender. Payout ratios on operating cash flow and free cash flow all remain below 48% over the past 5 years, but payout ratios on net income spiked up to 187% back in 2020. Broadcom's financial growth over the past 5 years has been absolutely stellar, with net income growing at 102%, operating income growing at 73%, operating cash flow growing at 17%, and free cash flow growing at 18%. If we invest $1,000 in AVGO today with an initial yield of 2.04%, 25% dividend growth, and 10% share price appreciation, our yield on cost after 20 years would be 509%, and our average annual return would be 17.8%. Over 20 years, almost $15,000 would have been paid in dividends, and we would earn $7,000 on the 20th year. Broadcom has been on an absolute tear over the past several months, increasing from a little less than $600 per share at the beginning of this year up to $920 per share today. Personally, I think this stock is overpriced, and that's reflected in the current yield being way below their 5-year average. I'm interested to see this new high get tested and find out where the new support is. I'm keeping my eye on this one, and you'll definitely be hearing from me once this stock goes on sale. Next is Skyworks Solutions, SWKS. Skyworks Solutions is a leading semiconductor company that specializes in manufacturing high-performance analog and mixed-signal semiconductors. The company primarily makes money through the sale of its chips, which are crucial components in various wireless and mobile communication devices. Skyworks' key revenue driver is the production and sale of radio frequency chips. These chips enable wireless connectivity and communication in smartphones, tablets, wearable devices, automotive applications, and other IoT or Internet of Things devices. As the demand for these wireless devices continues to grow, Skyworks benefits from increased chip sales, contributing significantly to their revenue. The company strategically positions itself as a key supplier to major smartphone manufacturers like Apple and Samsung. As these smartphone giants release new models with advanced features and capabilities, Skyworks often provides critical RF solutions for the improved connectivity and performance. This strong partnership with leading smartphone manufacturers enhances Skyworks' revenue potential. Moreover, Skyworks caters to other markets beyond smartphones, such as the automotive industry. As modern vehicles become more connected, Skyworks chips play a crucial role in providing wireless communication for various automotive applications, like infotainment systems and vehicle-to-everything or V2X communication. As 5G technology adoption continues to accelerate globally, the demand for Skyworks' high-performance RF chips is expected to increase further. Additionally, the company continues to innovate and develop new products, expanding its portfolio and revenue opportunities. In conclusion, Skyworks Solutions thrives by producing and selling cutting-edge semiconductor solutions for wireless communication, capitalizing on the growing demand for connectivity in various industries. Skyworks' current dividend yield is 2.2%, which is slightly higher than their 5-year average yield of 1.8%. Their 10-year dividend growth rate is 20% and their 3-year dividend growth rate is 11%, indicating they're decreasing their dividend growth. Skyworks has raised their dividend every year for the past 9 years, landing them firmly in the category of dividend challenger. Payout ratios on net income, operating cash flow, and free cash flow all remain below 41% over the past 5 years, with no annual reports of negative earnings. Skyworks has had very strong financial growth over the past 5 years, with net income growing at 6.7%, operating income growing at 8.3%, operating cash flow growing at 27%, and free cash flow growing at 46%. If we invest $1,000 in SWKS today with an initial yield of 2.17%, 10% dividend growth, and 10% share price appreciation, our yield on cost after 20 years would be 18.4% and our average annual return would be nearly 12%. Over 20 years, $1,500 worth of dividends would have been paid, and we would earn $211 on the 20th year. Skyworks hit an all-time high back in mid-2021 at nearly $200 per share. The stock started dropping and found support again around $80 just before the beginning of 2023. The current share price of $114 is reasonable in my opinion and gives us a historically high initial yield. The financial growth and increasing demand for their products makes me optimistic about the long-term prospects for the company as well. I think this is a pretty good choice for anyone looking for solid dividend growth and strong share price appreciation over the next decade or so. Next is Qualcomm Incorporated, or QCOM. Qualcomm is a global leader in the development and commercialization of advanced wireless technologies and semiconductors. The company's revenue streams are primarily derived from 2 main business segments: Qualcomm CDMA Technologies and Qualcomm Technology Licensing. The Qualcomm CDMA Technologies, or QCT segment, is the core revenue driver for the company. QCT designs and supplies integrated circuits and system software for mobile devices, including smartphones and tablets. Their Snapdragon processors, a well-known product line, power a wide range of mobile devices worldwide. Smartphone manufacturers license these Snapdragon chips, and Qualcomm earns revenue through the sale of these semiconductors. In addition to chips, QCT also generates revenue from other mobile-related products and services, such as modems and RF front-end solutions. These components enable fast and efficient wireless communication in mobile devices and other IoT products. The Qualcomm Technology Licensing, or QTL segment, focuses on licensing the company's extensive portfolio of wireless technology patents to other companies. QTL collects royalties from manufacturers that use Qualcomm's patented technologies in their devices. This licensing model has been a significant contributor to Qualcomm's revenue over the years. Moreover, Qualcomm invests heavily in research and development to innovate and develop new technologies that improve mobile communication, data transfer speeds, and power efficiency. By staying at the forefront of technological advancements, Qualcomm ensures a steady stream of revenue from licensing its intellectual property and selling cutting-edge semiconductor products. As 5G networks continue to roll out globally, Qualcomm's position in the market becomes even more critical. The company is well positioned to capitalize on the 5G revolution with its 5G-enabled chipsets, modem solutions, and patents, further solidifying its revenue streams from both QCT and QTL. QCOM's current dividend yield is 2.5%, which is about equal to their 5-year average yield. Their 10-year dividend growth rate is 7.5%, and their 3-year dividend growth rate is 7.3%, indicating they're maintaining their dividend growth. Qualcomm has raised their dividend every year for the past 21 years, making them a dividend contender. Payout ratios on net income, operating cash flow, and free cash flow all remain below 68% over the past 4 years, but they did have payout ratios as high as 111% back in 2018 and posted negative net income in that year. QCOM has had strong financial growth over the past 5 years, with net income growing at 39%, operating income growing at 28%, operating cash flow growing at 19%, and free cash flow growing at 18%. If we invest $1,000 in QCOM today with an initial yield of 2.54%, 7.5% dividend growth, and 7% share price appreciation, our yield on cost after 20 years would be 15% and our average annual return would be 9.3%. Over 20 years, $1,700 would have been paid in dividends and we would earn almost $200 on the 20th year. QCOM has had the weakest share price appreciation of all the stocks on this list, but might be the best deal. Their wide range of products and integral role in 5G technology makes their business resilient in the coming decade, and the safe payout ratios and strong financial growth make me comfortable with the dividend. Since the drop-off from their 2022 high, the stock has been testing new lows and it looks like we have decent support around $110 per share. If you like this company, that seems like a good price to get in. Next is Texas Instruments Incorporated, TXN. Texas Instruments is a leading semiconductor company that designs and manufactures a wide range of analog and embedded processors used in various applications, from consumer electronics to industrial equipment. The company's revenue primarily comes from the sale of these semiconductor products and related services. One of the key revenue sources for Texas Instruments is analog chips. Analog chips are essential components that process real-world signals such as sound, temperature, and voltage. TI's analog products are used in smartphones, automotive systems, industrial machinery, and medical devices. As these markets grow and demand for advanced analog solutions increases, Texas Instruments benefits from increased sales. Another significant revenue stream comes from embedded processors, such as microcontrollers and digital signal processors, or DSPs. These chips serve as the brain of many electronic devices, powering applications in communication systems, automotive control units, and Internet of Things devices. Texas Instruments' strong presence in these markets ensures a steady flow of revenue from embedded processors. Moreover, Texas Instruments provides various software and support services to complement its semiconductor products. These services include development tools, software libraries, and technical support, which add value to their products and help establish long-term relationships with customers. Texas Instruments' commitment to R&D enables the continuous development of cutting-edge semiconductor solutions. They invest in creating new technologies and improving existing ones, ensuring that their product portfolio remains competitive and relevant in rapidly evolving industries. By focusing on analog and embedded processing solutions and maintaining a strong presence in various markets, Texas Instruments has established itself as a reputable and profitable player in the semiconductor industry. TXN's current dividend yield is 2.75%, which is slightly higher than their 5-year average yield of about 2.6%. Their 10-year dividend growth rate is 23% and their 3-year dividend growth rate is 10%, indicating they're decreasing their dividend growth. TXN has raised their dividend every year for the past 20 years, making them a dividend contender. Payout ratios on net income, operating cash flow, and free cash flow all remain below 73% over the past 5 years, with 0 reports of negative earnings. TXN has had strong financial growth over the past 5 years, with net income and operating income growing at 13% and operating cash flow growing at 2%. Free cash flow, however, has been declining at 11%, mostly due to a sharp decline over the past 2 quarters. If we invest $1,000 in TXN today with an initial yield of 2.75%, 15% dividend growth, and 10% share price appreciation, our yield on cost after 20 years would be 75% and our average annual return would be almost 14%. Over 20 years, almost $6,000 worth of dividends would have been paid, and we would earn a little over $1,200 on the 20th year. After a massive bull run from mid-2020 to late 2021, Texas Instruments has traded more or less sideways between $150 and $180 per share. After posting negative free cash flow for the first time in 19 years, I wouldn't be surprised if this stock slips even further off its $200 high. If we see shares trading closer to pre-pandemic levels of around $125 per share, I'll definitely be buying in. I'll keep you posted. Last, we have Amdocs Limited, DOX. Amdocs is a multinational software and services provider that specializes in offering solutions for the telecommunications and media industries. The company generates revenue through software licensing, implementation, managed services, and ongoing support for its products. Amcor's core revenue stream comes from software licensing and related services. They provide a wide range of software solutions for customer experience management, billing and charging, customer relationship management or CRM, and digital transformation. Telecommunication service providers and media companies license these software products to enhance their operations and improve customer experiences. The implementation of these software solutions also contributes significantly to Amdocs' revenue. Amdocs works closely with its clients to integrate and deploy its software into their existing systems, ensuring smooth and efficient adoption. Once the software is implemented, Amdocs provides managed services, ongoing support, and maintenance. These services help telecom operators and media companies manage their IT infrastructure, ensuring the continuous operation and optimal performance of Amdocs software products. The recurring nature of managed services provides a stable and predictable revenue stream for the company. Moreover, Amdocs offers consulting and professional services to assist its clients in adapting to the rapidly changing telecommunications and media landscapes. This includes advising on digital transformation strategies, process optimization, and business analytics, adding another dimension to the revenue streams. Additionally, Amdocs fosters strategic partnerships with various players in the telecommunications and media industries. These collaborations often lead to joint ventures and co-creation of solutions, expanding Amdocs' market reach and revenue potential. With a strong focus on meeting the evolving needs of the telecommunications and media sectors, Amdocs continues to be a major player in the software and services space, driving innovation and generating substantial revenue from its diverse product and service offerings. DOX's current dividend yield is 1.86%, which is about even with their 5-year average yield of 1.89%. Amdocs' 10-year dividend growth rate is 15% and their 3-year dividend growth rate is 10%, indicating they're decreasing their dividend growth. DOX has raised their dividend every year for the past 10 years, barely making the cutoff for dividend contender. Payout ratios on net income, operating cash flow, and free cash flow all remain below 41% over the past 5 years, and no payments with negative earnings. DOX has had steady financial growth over the past 5 years, with net income growing at 9%, operating income growing at 8%, operating cash flow growing at 8.5%, and free cash flow growing at 12%. If we invest $1,000 in DOX today with an initial yield of 1.86%, 12% dividend growth, and 9% share price appreciation, our yield on cost after 20 years would be 23% and our average annual return would be 11%. Over 20 years, almost $1,600 would have been paid and we would earn nearly $250 on the 20th year. This is another tech company very near all-time highs. Amdocs nearly topped $100 per share in early July and will probably continue testing this resistance for the next month or so. I'm hesitant to buy in right now given the high price, but it seems like their dividend has kept up with the strong share price growth. With strong financial growth and safe payout ratios, the dividend seems safe. If we drop back down to $80 per share, I'll definitely buy in, but I can't justify buying at the current prices. These 5 tech stocks show great promise for the coming years, but there are other companies outside the tech industry that you should take a look at. We recently did a video on the top 5 dividend stocks across all sectors, which you can watch by clicking the video card here or the link in the description. To see all the stocks I'm invested in and receive buy-sell alerts every time I make a trade, click the link in the description or in the pinned comment. Thanks so much for watching. As always, stay safe and take it easy.